Imagine waking up one morning and realizing that almost everyone around you is convinced they have found a guaranteed way to get rich. Friends, neighbors, shopkeepers, even people who had never invested before are suddenly talking about stocks. Prices keep going up, no one wants to be left behind. It feels exciting, unstoppable, and strangely logical. Until one day it all collapses. This is not a story from yesterday's headlines. This happened over 300 years ago. And surprisingly, the same emotional forces are quietly shaping today's tech-driven markets. Today, we are going to travel back in time to one of history's most famous financial disasters, the South Sea Bubble, and then bring its lessons straight into the modern world of big tech, artificial intelligence, and trillion-dollar valuations. By the end of this video, you may start seeing today's market headlines very differently. The South Sea Bubble took place in early 18th century Britain, a time when global trade was expanding and the idea of investing was becoming popular among ordinary people. The South Sea Company was created in 1711 with a bold promise. It claimed it would generate massive profits through trade with South America. The problem was that most of this trade was either extremely limited or outright impossible due to political tensions and war. But that detail barely mattered to investors at the time. What mattered was the story. The company offered the public an exciting vision of endless wealth tied to overseas trade, exotic goods, and national prosperity. It also had strong political connections, which made it seem trustworthy. As word spread, enthusiasm exploded. The company's stock price soared, not because of real profits, but because everyone believed it would keep rising. This belief fueled a feedback loop. Rising prices attracted more investors. More investors pushed prices even higher. Soon, the market was driven almost entirely by emotion, speculation, and fear of missing out. People borrowed money to invest. Others sold homes and businesses just to buy shares. Rational thinking was replaced by blind confidence. At its peak in 1720, the South Sea Company's stock had increased by several 100% in a matter of months. Britain was in the grip of a full-blown financial mania. New companies with absurd business ideas appeared overnight, promising incredible returns. One famously advertised itself as a company for carrying out an undertaking of great advantage, but nobody to know what it is, and people still invested. Then reality arrived. Investors slowly realized that the South Sea Company's profits could never justify its valuation. Confidence cracked. Selling began. Prices fell. Panic replaced optimism. Within weeks, fortunes were wiped out. The collapse devastated individuals, ruined families, and shook the entire British economy. The bubble burst, but the psychological scars lasted for generations. Now, let's fast forward to today. At first glance, modern tech giants look nothing like the South Sea Company. Today's firms build real products, generate real revenue, and shape how we live and work. Smartphones, cloud computing, social media, and artificial intelligence are not imaginary. They are powerful and transformative technologies. But the echo of the South Sea Bubble is not about fake businesses. It is about human behavior. In today's markets, certain tech companies have reached valuations that seem almost untouchable. Trillions of dollars are assigned to a handful of firms. Investors justify these prices by pointing to future growth, innovation, and dominance. The language may be more sophisticated now, but the emotional engine is familiar. When investors believe a company is too big to fail, or that its growth is inevitable, caution often disappears. Metrics become flexible. Risks are minimized. Any criticism is dismissed as outdated thinking. This is how bubbles quietly form, not through fraud alone, but through collective overconfidence. One of the strongest parallels between the South Sea Bubble and modern tech markets is the power of narrative. In 1720, the story was global trade and empire. Today, the story is technology changing the world. Artificial intelligence, automation, and digital platforms promise massive productivity gains and new industries. These promises are not false, but they can be exaggerated. When a compelling story dominates the conversation, numbers often take a backseat. Investors focus more on what could happen than on what is happening. Earnings today matter less than potential tomorrow. This mindset can push valuations far beyond what current fundamentals support. Another similarity lies in accessibility. During the South Sea Bubble, investing moved beyond elites and into the general public. Today, investing is easier than ever. Mobile apps, social media influencers, and 24-hour financial news have turned markets into entertainment. This democratization has benefits, but it also amplifies herd behavior. When millions of people receive the same bullish messages at the same time, markets can move rapidly and emotionally. Online communities reinforce shared beliefs. Dissenting opinions are often ignored or attacked. Just like in 1720, few want to be the person who missed out. It is also important to understand that bubbles are rarely obvious while they are happening. People inside a bubble do not feel irrational. They feel informed, confident, and justified. Every price increase seems to confirm the belief that they were right all along. Warnings sound pessimistic. Skeptics are labeled as negative or fearful. This psychological trap is timeless. The South Sea investors were not foolish people. Many were intelligent, educated, and well-connected. What they shared with modern investors is the same human wiring. We are social creatures. We look to others for validation. When everyone around us agrees on something, it feels safe. So does this mean today's tech giants are a bubble waiting to burst? Not necessarily. History does not repeat itself perfectly. Many modern companies are profitable, innovative, and deeply embedded in the global economy. The lesson is not that technology is overvalued by default. The lesson is that expectations matter. When expectations become unrealistic, even great companies can disappoint. A stock does not have to fail to fall. It only needs to stop exceeding extreme expectations. In the South Sea bubble, the crash did not require the company to disappear. It only required investors to realize it could not deliver miracles. Another echo of the past is the role of leverage. During the South Sea bubble, many investors borrowed heavily to buy shares. Today, leverage appears in different forms, such as margin trading, derivatives, and institutional risk-taking. Leverage magnifies gains, but it also magnifies losses. When prices fall, forced selling can accelerate declines. There is also the issue of concentration. In both eras, wealth and attention clustered around a small number of assets. When confidence in those assets weakened, the damage spread quickly. Today's markets are heavily influenced by a handful of mega-cap tech companies. Their movements affect indexes, pensions, and savings accounts worldwide. History shows us that markets are not just financial systems. They are emotional systems. Fear and greed do not disappear with better technology. They adapt. Algorithms may trade faster, but humans still set the rules and the expectations. So what can modern investors learn from the South Sea bubble's echo? First, separate stories from numbers. Great stories can inspire innovation, but investments require discipline. Understanding revenue, cash flow, and realistic growth rates matters more than height. Second, remember that popularity is not safety. When everyone agrees on an investment, risk often increases, not decreases. Crowded trades leave little room for error. Third, humility is essential. No market trend lasts forever. Innovation continues, but valuations move in cycles. Respecting uncertainty is not weakness. It is wisdom. Finally, history is not a warning to stay out of markets. It is a guide to staying thoughtful within them. The goal is not to avoid progress, but to avoid blind belief. The South Sea bubble reminds us that technology changes, markets evolve, and financial instruments grow more complex. But human psychology remains remarkably consistent. The same excitement, the same fear of missing out, and the same confidence that this time is different echo across centuries. As you watch today's tech headlines, soaring valuations, and bold predictions, ask yourself a simple question. Are we seeing innovation supported by reality, or belief running ahead of evidence? The answer may not be obvious, but asking the question alone puts you ahead of most investors in history. If you found this perspective useful, take a moment to reflect before your next investment decision. Markets reward patience more often than excitement. And sometimes the loudest lessons come from the quiet echoes of the past.